So now I'm going to show you on the options table how this would work when you're selling a covered call. So I have 100 shares of Tesla, and I'm going to sell one covered call against it with a weekly expiration. So I'm going to close the video because today I'm going to show you, as promised, how to sell it with the options table. Last video was the walkthrough, the explanation verbally. Now this will be visually. Alright, so here's our 100 shares of Tesla. Remember, we need at least 100 shares to sell one call option. So we look here, and then we go to, this is the TD Ameritrade mobile trader app. We go to show Tesla details, and then we go to options, and what we're going to do is look at the next expiration date, because today is Thursday, July 18th. We could sell the expiring tomorrow, but that's too soon. So let's go out 1 week, July 26th. And then we go down to where it's at the money. All right, so Tesla is at 253. So 252.5 and above would be at or in the money. These are all in the money, really. And then the further out you go, the less likely it is that the strike price will be hit, but the lower the premium. So you see how this starts out at 970. If I sold at 970 call, if I click on bid and then I go here, you can see you're gonna get around $970 in credit for selling it today, minus a small commission. But I don't want to do that because I like to keep my 100 shares. The likelihood that they'll be called away from me is extremely high. So I'm going to cancel that, and I'm going to go down to where this number over here is around 0.2. And what that is the delta. So you can see as these numbers go down, the amount of premium goes down, because it's less likely that these higher and higher strike prices will be hit by this date, July 26th. So I'm going to scroll down and sell. So if I sell around the 0.2 delta, that gives it a pretty low chance that that strike price will be hit by next week, by July 26th. Okay, so today is Thursday, July 18th. I'm going out just a little bit more than a week, like a week and a day, and I'm going to sell that. It's between the 0.22 and the 0.19. If you want to be a little bit more conservative, go with the 0.19. Take a little more premium, go with the 0.22. And again, this is just a very simple explanation. There's more advanced topics to consider for just a covered call, such as, is Tesla up or down today? Has the option price been changing to the positive or negative? So you see how these call options are negative change. That means if you look at the put, these put options are positive change. The put are increasing in value, the calls are decreasing in value. So normally I would sell puts on down days and calls on up days, because the premiums increase. If you're selling a call on a day that Tesla's up, then you get more premium. If you sell a put on a day Tesla's down, you get more premium for that put. Anyways, going back to what we're starting, 0.22, I'm going to sell that. That's a call. Again, it says calls up here, but what we're going to do is go down to the point. It's between 0.22 and 0.19. I'm going to click on bid, then that changes to paper trade spread. I'm going to confirm July 26th, 275 call. It's the weekly, and I'm selling it to open. And this is just going to be a naked call because I already have the 100 shares. I always bump up the credit just a little bit so it's outside the range, be a little more optimistic. I can do GTC because it's fine if it fills today, tomorrow, even next week. Confirm paper order, send paper order, and then stand back and watch. It's waiting to be filled. It's got to go from 310 to 315, and then it'll be triggered and sell. So to go over to my other account, that's just a demo account. One of my actual accounts, I did a short call on Tesla this week, and right here, and this is expiring tomorrow. Again, today's July 18th. This is just a naked call. So when you get tier 3 options approval, you can sell naked calls. You don't actually have to own the 100 shares. So this is just a naked call. It's not a covered call. It's a naked call. And you can see that the profitability is 68% because of theta decay. I opened it earlier this week because I noticed that Tesla was overbought. So I opened it, what was Monday? Today's Thursday, so what, the 15th? That was on the 15th. There. And you can see Tesla was up that day, so the premiums were juicy. And it was overbought. RSI was off the charts. He also had some other technical indicators confirming that. Williams percentage off the charts, stochastic off the charts. Implied volatility was a little bit lower than I'd like it, but this would be a great time to sell whatever it was, call or put. But look at that implied volatility. Juicy premiums there. Anyways, I sold it on the 15th. It was an up day. I got a good premium. If I sold it today when it was down, even though the strike is a little bit higher, it still would probably be lower premium. Remember I showed you that percentage change, green or red? Today, the percentage change for a call would be red because it's decreasing in value because Tesla is going down in price. It's already gone down $2, and I have other videos on RSI and stochastic and how I knew that selling a call then would be a good idea because it's oversold. So, overbought over here. So I sold that, and then what happened was Tesla went up another day. I kicked myself. Went up another day. Like, oh man, I should have waited. Should have sold my calls. But look what's happening. Since yesterday, Tesla is on its way down, and that means my call option that expires tomorrow is becoming very profitable, 73% now, because there's so much theta decay. I sold it for 1.45. Now it's worth 0.39. So I could buy it back for a profit because I sold it for more than I could buy it for. That's one way to profit. Sell high, buy low. Buy low, sell high, buy low. Either way, you make a profit. So that has made me, $84 today, $106 total, and I didn't have to buy anything. I just sold. I didn't even have to own the shares. I just sold the call. So that is how you sell a covered call. This was an example of selling a naked call, but today I wanted to talk about selling a covered call, and I went off topic a little bit. I need to get better at that, but please give me some feedback if you like this video, what else I can do better. The call is still working, so Tesla would have to bump up in value a bit before that 3.15 mark is hit. That's the value of the option I sold. It's not, don't confuse that with the strike price or the stock price, but see how it's climbing now? It might be hit within the next hour. It just has to touch 315. It just has to kiss it once, and then it's going to get triggered. Another similar example of selling calls. I sold a call on Amazon also at the beginning of the week because Amazon looked extremely overbought. It was Prime Week. People had unrealistic expectations, and you're not going to have an edge by selling on news that is predicted in public, like Prime Day. Everybody knows when Prime Day is. Why would you be rewarded for having an edge for selling something based on very public news? You have to have an edge that is different from everybody else. And my edge is I look at overbought, oversold. So RSI, way overbought, and it tends to mean revert. So I sold a call on the 15th because Amazon was overbought. You can see over here. And then I actually timed that just right. It had opened at 2021. That was right about the high of the day. It touched 2022, and I sold it right early in the morning on Monday. And you can see it's fallen. And I wanted to sell it instead of weekly, which Amazon allows. I wanted to sell it a month out because it was such an unprecedented overbought level. And it's only about halfway to full profitability, and it's already $815 of profit. So again, this is a paper money account. Amazon is extremely expensive and extremely risky for selling just covered calls because, as you can see in the past, Amazon can increase $30 in one day, no problem. It's down $24 just today alone. But I mean, look at some of these jumps in prices where, you know, Amazon went from a low of $18.18 to $18.84 on that day, you know, a low of $19.43 to a high of $19.90. So $50 jump. You have to be prepared for that. But that's the point of, first you start with selling covered calls, and then you get to the point where you sell naked calls. So you don't actually own the 100 shares. You just sell against your margin. You have the margin to sell that covered call. Sell that naked call. Of course, it takes margin usually, unless you have a huge cash account, to sell covered calls too. But this is the example I wanted to show. That selling calls can be very profitable. It was an out-of-the-money call. It's very unlikely at this point it's going to hit $21.50 by August 16th, but not impossible. So as Amazon starts to go back up, then my profit will start to go back down. All right, so that's it.